Hi, I'm Stephanie Weeks. Welcome to the channel, and if you are returning, thank you so much for coming back. I have been doing mortgage loans for 18 years, and today I want to talk to you about passing property, real estate, down to your children, and maybe we'll even talk about some other family members as well. So be sure to stay tuned till the end. I try to keep it jam-packed for the whole entire time. So thank you so much for tuning in. Let's get started right away. I'm going to be looking here and then looking down a lot because I'm going to do some calculations and stuff for you today specifically. So when I'm talking to you about passing down property or real estate to your children, I'm actually going to talk about family members. So it might not be limited to your children, but it could be a niece or nephew, a grandchild. It could be a sister, brother, mother, father, who knows? It might be the kid kind of passing up. So this comes across my desk maybe about 10% of the time, and it's pretty interesting because now I'm talking to you from the mortgage perspective, not from the tax perspective. So you definitely want to check with your CPA as far as some of the things I'm going to talk about, because I am talking from the mortgage perspective and not the tax perspective. So what a lot of people don't know, and I think it's super, super cool, is that we can do something as lenders called a gift of equity. And a lot of times when you're passing down real estate to your children, you may not be just giving it to them for free because, you probably worked really hard for that and it may be part of your retirement plan. And so what a lot of people don't realize is you can do things such as gift of equity, and that's what we're going to talk about a little bit as well. When it comes to getting properties from family or selling and buying to and from family members, the most common question that I am asked is, they don't have down payment, so do you have any options for that? Well, let's talk about that, because when you are doing a gift of equity or you're buying or selling from relatives, a lot of times we can use the equity in the property in order to cover down payment, maybe even some closing costs and prepaids, maybe even to avoid mortgage insurance, which is a really cool way to structure this and do it. Now, keep in mind, when it comes to mortgage lending, and that's Fannie, Freddie, Ginnie, VA, RD, when an appraisal is done, the loan to value is based on the sales price or the appraised value, whichever is less. So if I'm buying a house for $400,000 and it's worth $1 million, it doesn't matter. My loan to value is based on $400,000 and how much percentage of down payment I'm putting on that. But gift of equity could solve our problem. So let's use some specific examples, okay? All right, so I had one that came to me and they were looking to get rid of a $500,000 house. That's the value. We've got another one at $600,000 we'll talk about as well. But a $500,000 house, and the relative that's getting rid of the house or wanting to pass along the house, they need to get $400,000, but the house is worth $500,000. So remember I said appraisal or sales price, whichever is less. Well, gift of equity can help us here, because if I was buying a $500,000 home from a non-relative and it was worth $500,000, but I'm paying $400,000, then my loan to value, my PMI, everything is based on my loan amount in relation to the price of $400,000 in this example. But we're going to talk about gift of equity and how we can use that to our amazing advantage. Now, if you haven't subscribed, please do. Don't forget to like as well. I did also build the Ultimate Mortgage course, which is available for sale, and I'll drop a link to that below in the description as well. And whether you're looking to finance a home in 9 days or 90 days, give me a call, shoot me a text, or send me an email. I can help you in a number of states, and I'll be adding more states as well. So, all right, let's dive into some numbers. My $500,000 example, we needed to get out $400,000. Now, in this example, my buyer was ready and able to come up with $10,000. But of course, they wanted the best interest rate and they wanted to avoid mortgage insurance if at all possible. So what we would do in this example is we would have a sales price of $500,000. That's the price. That's what all the paperwork would show. That's what the taxes are going to be based on, $500,000. And then I'm going to show a loan amount in this example of $400,000. And then if I wasn't having a gift of equity, then my cash to close in this example would be $100,000 plus, let's say, $10,000 if that's how much closing and prepaids costed. So they would have to come up with $110,000. But because I'm using a gift of equity, we actually use that as a credit. The money's not passing, the equity is being gifted. So the $100,000 would then show as a credit, and it literally shows up as gift of equity. And so in this case, the cash to close would be $10,000. And they get a fantastic interest rate because their loan to value is 80%, not 100%, because it's a $400,000 loan in relation to a $500,000 home. And because we're at 80%, not only do we get a great interest rate, but we have no mortgage insurance at all, saving thousands of dollars. It's so freaking awesome. I love when I get to do these because a lot of times they'll come to me from other lenders just as a second opinion, and I structure it this way and they're like, wait, what? The other lender didn't tell us anything about that. And so it's really, really fun and exciting. Now let's use my next example, which was the family that was giving a $600,000 house, and they only needed, actually in this example as well, $400,000. So they wanted $400,000 for a house that for their kids, and it was worth $600,000. So you've got $200,000 in equity in this example if we're using the gift of equity and we're not going by the guidelines of buying from a non-relative, okay? Now in this example, the buyer wanted to come up with as little money as possible, so they actually wanted to structure it to where we rolled in all the closing costs. And in this example, the closing costs were closer to $15,000. That's closing cost and prepaid, taxes, insurances, upfront, escrow, all that stuff, not just closing cost. But $15,000 in this example because I'm going to round up. So what they wanted to do is they actually wanted to borrow $415,000 because they needed to pay $400,000, and then they also wanted to borrow the $15,000 so they didn't have to come up with that in cash. Now, so I've got $415,000 divided by $600,000. That gives me a 69% loan to value. When it comes to interest rates, the absolute best rate is when you put at least 30% down. So they're now going to qualify for the best category of rates, assuming that their credit is excellent as well. And they're not going to have mortgage insurance because we're at a 69% loan to value, not 100%, not even 80%. That's with rolling in the closing cost. And so what this example, my gift of equity is $200,000. So if this was a regular $600,000 purchase, then, and they wanted to borrow $415,000, they would be coming up with a lot of money, as you can see. But this gift of equity is super amazing, and I've used it even in instances where the extra value is only like $5,000. It's not always this great, which is pretty awesome. And hey, if I have any family members that want to do this for me and give me a $600,000 house for $400,000, I will gladly make that purchase. But seriously though, so I've done this with as little as $5,000 in equity, and they just use that to help pay their closing costs. And of course, they still had a high loan to value, but that was okay. It still worked out. You don't have to have hundreds of thousands of dollars in equity to do this. You don't. It can literally be as little as a few $1,000s. And if you're buying and selling from a family member and there's no equity to be gifting, you're just paying what it's worth and what it's valued at, and they're accepting what it's worth and what it's valued at, it's just done as a regular transaction. No big deal. Really hope this has helped you today. I love to hear your comments, so please let me know if you have any questions, and I look forward to seeing you in the next one.